Goldman Sachs suggests buying these new stocks now for growth. Conventional wisdom dictates that a U.S. recession is imminent either during the second half of this year or the first half of the next. But just how much should we credit that? While there are economic headwinds in play, we should also remember that the pace of inflation is easing, unemployment remains low, and the second quarter earnings season showed a high proportion of surprises to the upside. If it's not a completely rosy picture, it is far from doom and gloom. And in the eyes of Goldman Sachs equity strategist David Costin, it's a sign that the U.S. may be ready for a rebound. Laying out this case, Costin writes, in quote, resilient U.S. economic growth, which is the primary variable in our sales model, should support S&P 500 revenue growth in 2023. Goldman Sachs economists forecast 2.1% real U.S. GDP growth in 2023 compared with a consensus estimate of 1.6% growth, which partly explains our above consensus sales growth forecast. Our economists assign just a 20% probability that the U.S. economy enters a recession during the next 12 months compared to the median forecast 54% probability. Riding on this positive sentiment of growth potential, the Goldman Sachs analysts have been upgrading the ratings for several stocks recently. Here are the details on two of their picks. The first company we'll look at is Teledyne, an engineering firm involved in the creation and production of enabling technologies for industrial growth markets. The company produces a wide range of products including digital imaging sensors, broad spectrum camera system, monitoring and control instrumentation, aircraft information management system, and electronic and satellite communication system. The company operates in four divisions: instrumentations, digital imaging, engineered system, and aerospace and defense electronics, and its product lines have found their way into multiple applications. Teledyne is based in California but also has operations in Canada, the UK, and Western Europe, and boasts a market cap of approximately $19 billion. The firm's strong position as a leader in high-tech hardware has led to a solid revenue stream for the past couple of years. Teledyne consistently brought in north of $1.3 billion in quarterly revenue. The company's last report for second quarter 2023 showed a top line of $1.42 billion, 5.1% better than the year ago quarter, and $11.43 million higher than the pre-release estimate. Now, the company's bottom line earnings figure, reported as a non-GAAP diluted EPS of $4.67, was 2 cents above expectations and compared favorably to the $4.43 reported a year before. Teledyne reiterated its full-year non-GAAP earnings outlook, predicting an EPS of $19 to $19.20 for 2023. Now, the last 6 months, however, have not been great for the stocks, which has seen an 8% decline. Goldman analyst Noah Poponak puts the pullback down to concerns about the long-term profit margin level in the company's digital imaging segment. However, pointing out the overall quality of the company and its strong fundamentals alongside a relatively depressed share price, Poponak sees plenty to like here. Now, TDY is one of the highest quality, most consistent, best managed companies we cover that compounds cash flow over time. Poponak explained, the stock has pulled back recently to relative valuation lows, just as the balance sheet is narrowing full force again for further deployment post FLIR integration, while the core organic fundamental picture remains strong. We see upside to consensus earnings expectations and find current valuation attractive. Accordingly, Poponak has boosted his rating from neutral to buy and sets a $495 price target, implying a potential upside of 23% for the year ahead. There is a general agreement on Wall Street that Teledyne is a quality stock, as shown by the unanimity of the four recent analyst reviews, leading to a strong buy consensus rating. The stock's $403.63 trading price and $493.25 average price target combined to indicate room for 22% share appreciation in the next 12 months. Next up is Okta, a cloud-based software company focused on user authentication and identity control. Okta offers a product line based on its identity cloud, and the company's platform can be used for both customer and workforce identity verification. The cloud product allows users to secure the system to ensure that customer information is kept secure and that system access by employees, contractors, and partners is in line with security protocols. Okta builds its platform as extensible, easy to use, and neutral, and boasts that it can be easily integrated into customers' existing solutions so that users can choose the best technology for their needs. The company has seen more than 7,000 integrations of its software and claims a customer base more than 18,000 strong. The cybersecurity industry, where Okta dwells, was estimated at about $202 billion last year, and it's expected to reach $425 billion by 2030. This makes it a huge growth industry with a massive addressable market and plenty of room for a savvy company to expand. Okta has shown that it is equal to the opportunity. At the end of the calendar year of 2022, Okta switched from posting net losses to posting net gains. In its last financial result for the first quarter of fiscal year 2024, released at the end of May, Okta showed a top line of $518 million of revenue, more than $7.4 million above the forecast and up 24% year over year. The company's earnings reported as a bottom line of 22 cents per share by non-GAAP measures was 10% better than expected and a strong turnaround from the 27 cents net EPS loss reported 1 year earlier. The solid results were supported by $503 million in subscription revenue, a forward-looking metric that was up 26% year over year. In anticipation of a re-accelerated growth, Goldman Sachs analyst Gabriela gives Okta a rare double upgrade from sell to buy in her recent note on the company, pointing out several reasons why Okta is likely to deliver strong growth ahead. She wrote, "We see a path to 12M outperformance driven by CRPO and ARR acceleration back to 15 to 20% as one. Okta anniversaries headwinds in its customer IAM business tied to the merging of its organic and acquired product portfolios supported by our bottom-up segment model. 2, the workforce segment stabilizes post go-to-market changes and headwind from macro. And lastly, Okta ramps on cross-sell tied to new product cycles such as IGA, identity governance and administration, and PAM, privileged access management. She also explains why Okta holds a good position to maintain growth in the face of larger competitors, saying of the company, "While we believe competitions from Microsoft will remain an overhang on the stock, we reflect this in our bull case scenario by continuing to discount Okta's multiple by approximately 30% relative to peers. Even with this discount, our updated scenario analysis suggests a 3-to-1 ratio upside downside skew based on our financial year 26 and current year 25 estimates." Looking ahead, she complements her new buy rating on this stock with a $91 price target, suggesting a 21% upside potential on the 1-year horizon. Overall, Okta shares holds a moderate buy consensus rating from the street based on 24 recent reviews that include 16 buys, 7 holds, and 1 sell. The stock's average price target of $93.22 is slightly more bullish than the Goldman review and implies a 30% upside from the current trading price of $71.73.